Well, I think the direction of travel is for silver to perform better than gold over the medium term. That doesn't mean on a week by week or month by month basis, but I think we're looking forward to the next couple of years, most likely. But of course, we might get, we don't know if we'll get this, but we might get a blow-off top. What's a blow-off top is when the price of the asset, silver in this case, rises very, very rapidly, far more rapidly than one would expect. And that draws attention to all the silver hoarders who then say, I'll take advantage of this. And that will put a cap on the rise when it happens, right, and bring out sellers. And if we go very, very rapidly to, say, $150, which I cannot exclude, then you have this wave of sellers come out and it might come back to 50, but we're still going to be ending up at a much higher level than today's level.
Clive Thompson, a veteran analyst, projects that silver could reach $150 per ounce. His analysis draws on historical precedent, noting that silver's previous peak of approximately $50, achieved around 2011, would translate to well over $100 in today's inflation-adjusted terms. This perspective underscores the substantial upside potential from current levels. Technical analysis reinforces this bullish outlook. Mike Maloney of the Gold and Silver Show have identified a rare multi-year cup and handle formation breaking out across 6-month, quarterly, and annual timeframes. Maloney believes this pattern could drive silver beyond $150 per ounce, with potential targets extending to $300, $400, or even $500 or higher. Thompson notes that the direction of travel appears to favor silver over gold in the medium term. While this doesn't necessarily mean silver will outperform gold on a week-by-week or month-by-month basis, he believes the outlook over the next couple of years is more promising for silver. This view aligns with recent performance data, which shows a shift in momentum. Although gold initially outperformed silver in early 2025, its rally stalled in June. Analysts attribute silver's growing strength to a combination of rising industrial demand, persistent supply deficits, and increasingly favorable market conditions. Thompson emphasizes that while short-term fluctuations may continue, the broader trend over the next 2 years strongly favors silver. Before we dive in, don't forget to like, share, and subscribe. Hit the subscribe button and turn on the notification bell to stay up to date with our latest updates and insights.
Well, not on a daily basis or a weekly basis, but I think over the longer run, silver is going to be the better performer. And the reason is because, first of all, there's two reasons really. First of all, unlike gold, there's a supply and demand dynamic in silver. And we know, based on the information from the Silver Institute, that since the last 3 or 4 years, the demand for silver has been rising rapidly, mainly due to increasing electronics, whereas the mines of silver has been dropping for the last, not forecast to increase. Probably because a lot of silver is produced as a byproduct of other things like copper mining, although we've just seen that copper has just hit an all-time record. So maybe there will be a bit more silver coming out of the ground. So there's that, the supply and demand dynamic. But the other thing to say is, for a lot of silver is the poor man's, some might say it's platinum today, but I think silver's really the poor man's gold. So when people feel that they need to park money somewhere, when it's getting to a wider audience, the rich people have heard first and they're buying gold, but the people at the next layer down aren't quite as rich. And they're probably saying, oh, well, I'll buy myself a few silver. This more and more of my friends announced to me, they know I collect silver coins, they know I collect gold, but they come to me and announce proudly, oh, I bought this coin. They show me one silver coin. I'm thinking, it's not really moving the needle for you, because when I'm buying them, I'm buying 20 or 30 or 50 of them at a time in silver. People are starting to dip their toe in and buy gold, silver and gold. And then when they come to me and show me a gold coin, they've got these little 1/4 ounce or 1/10 of an ounce coins that they bought. Again, but I think we've got a class of people coming into the market now as buyers, which wasn't there before, and they're going to buy silver. In a parabolic move, there's no real top in a world where you've got money being printed. It's what captures the public's investment. Certainly, silver could go above $150. I mean, if you just simply take the previous all-time high of $50-odd, which was well, I think they had that in something like 2011, something like that, a decade ago. If you just adjust that for inflation, it's got to be at least double that. So we're already above 100. But in bull runs, there's no top that people can describe. Bull runs can just keep going and going. Suddenly, there's no. Well, I think the direction of travel is for silver to perform better than gold over the medium term. That doesn't mean on a week by week or month by month basis, but I think we're looking forward for the next couple of years, most likely. But of course, we might get, we don't know if we'll get this, but we might get a blow-off top. What's a blow-off top is when the price of the asset, silver in this case, rises very, very rapidly, far more rapidly than one would expect. And that draws attention to all the silver hoarders. So this is a common feature of a rapidly rise. Assets rise rapidly and people jump on board, I'll capture the gap rise. But at some point, those people are chasing. And if we go very, very rapidly to, say, $150, which I cannot exclude, then you have this wave of sellers come out and they might come back to 50, but we're still going to be ending up at a much higher level.
Clive Thompson remains decidedly bullish on gold, rating it a definite buy, with projected returns of approximately 8% above inflation. His confidence stems from expectations of rising inflation, which would enhance gold's real returns. Central banks are reinforcing gold's institutional appeal through strategic reserve building. Rather than relying solely on market purchases, central banks increasingly source gold directly from domestic mines. This approach proves more cost-effective while supporting local industries and strengthening reserves without impacting foreign exchange balances, underscoring gold's continued relevance in sovereign wealth strategies. The macroeconomic backdrop strongly favors gold. Economists and Federal Reserve officials expect inflation to accelerate through summer as tariff impacts filter through the economy. June data reinforced these expectations, suggesting policymakers may delay interest rate cuts pending clearer economic trends. Thompson assigns gold an attractiveness rating of 70 to 80 out of 100, reflecting substantial investment merit despite his enthusiasm for silver's explosive potential. Gold's performance validates these fundamentals. The metal rose 26% in US dollar terms during the first half of 2025, achieving double-digit returns across multiple currencies. This record-setting trajectory reflects a confluence of supportive factors: a weaker US dollar, stable interest rates, and heightened geoeconomic uncertainty, all of which are driving strong investment demand. Let's get back to the interview.
A quick run through all the major commodities and assets I could think of, and there was, with one or two exceptions, they were all on a sort of 5-year basis, looking as high as at the top of the chart. What I think we're now in a period which I would describe for the last 5 years. It's some kind of melt-up. And a melt-up is a situation where, in general, the prices of tangible assets, that is, things that people want to own and where the supply cannot be increased as fast as fiat, that could include intangibles too, if you like. The price of all those kinds of things has been on the rise as people are saying, where can I park my money? And of course, where they park their money, it flows. One day it's flowing into equities, the next day it's gold, the next day it's Bitcoin, the next day it's property, and it goes around in circles, and you have these phases where things take off and rush. We've had this rush on silver, we've had this rush on platinum in the last few weeks, where those, for example, silver, which was trading at $32, $33, has rocketed up to $38 in almost no time. That's what's that? That's $6. That's nearly 20% in a week or two, a few weeks. And gold has done nothing in that period. But then before that, it was gold, and silver was doing nothing. And then, of course, we've just the last few days we've seen this 20% rise in the Bitcoin price. So the money sort of jumps on the latest bandwagon, and then it leaps onto the next one, then it leaps on the next one, and then it comes back to the first one. Gold is well supported, definitely a buy. I think I'm going to put it, I have a forecast expected financial return of 8% above inflation, whatever inflation will be, and I think inflation will rise. So I'd classify that as about 70 or 80. I think that the case is more compelling because they are way below the level they were in 2011. According to my calculations, the price-earnings ratios of many of these gold miners is going to be below 10 next year. So we'll have low price-earnings ratios with high growth because the earnings will have risen, the dividends will have risen, and that should be self-correcting in terms of the price-earnings ratio rising, i.e. the share price rising. So I think gold miners will perform very well, so I'm going to give it a 9. I publish on LinkedIn about once a year an asset allocation table. It really hasn't changed very much at all. The last actual publication was in September 2023. I haven't done one since then. on that occasion, I increased my allocation to silver from 6% to I increased my allocation of gold from 6% to 9%, and I left my allocation of silver at 6%. So between the two of them, that's 15%. That's probably below the figure you want to hear. But of course, if you'd bought the 15% then, it would already be 20+% because of the price rise. You probably want to hear a much higher number, but
No.
there's many other asset classes I like to invest in. The way I described it is silver and other precious metals, including silver held by custodians and banks and ETFs and silver mining shares and silver custody bars, bullion coins, collectible coins, old used coins, with an allocation to platinum as well. And that more or less the same type of thing for gold. So that's kind of how I describe it. So in other words, you definitely want to have some gold and some silver where you can get your hands on it quickly and easily.
Right.
But there's a limit to how much you can self-custody. So beyond that, you have no choice but to use other things like silver miners or ETFs.
The precious metals market has seen a remarkable surge in 2025, with both silver and gold breaking through key resistance levels and establishing new price floors. Following a period of market fatigue in June, marked by high intraday volatility, both metals entered a healthy consolidation phase that laid the groundwork for the current rally. Silver and gold continue to show their strategic importance in a changing economic environment. Gold remains a dependable store of value with solid long-term prospects. At the same time, silver stands out due to its dual role as a monetary and industrial asset, offering greater upside potential in the medium term. Is silver leading the charge in a new era for precious metals? Share your thoughts in the comments below. If you enjoyed this video, don't forget to like, share, and subscribe. Only 4.5% have subscribed, so hit the bell icon and turn on notifications to stay updated. Your support enables us to continue delivering the latest market insights to you and the broader community. Thank you for watching.